All right, markets have really recovered from their tapering tantrum, if you want to call it that, and the Federal Reserve indicating, and this goes back to a meeting back in July before everything really was hitting the fan, that they would start scaling back their Treasury security purchases sooner rather than later, like maybe this year. Forget about next year. But some are putting this in some perspective here. It's not as if they're selling en masse these securities. They will buy probably a little less. So they average, I think, about 120 billion a month, about 80 billion or so in, excuse me, in Treasury securities, and another 35, 40 billion in mortgage-backed securities, that sort of thing. They might slice that down 110 to 100 billion net per month, but still buying more than they're selling. Michelle Snyder on the significance of that, the managing director at Market Gauge Group. Is that what's going on here, Michelle? Are they reassessing? You know, they're pivoting. They're indicating they're going to pivot, and Wall Street, you know, isn't keen on the pivot, but it's not as big a pivot as some might fear. What do you think?
Well, like you just said, those minutes that came out yesterday came from a couple of weeks earlier. And things have changed now over the last few days. Powell spoke a couple of days ago and addressed the fact that he's still very concerned about the Delta variant, and he's still very concerned about the labor market, which are still two very legitimate concerns. So I think the market got a little ahead of itself in terms of believing that the Fed would actually taper. And like you said, it wouldn't even be as severe as what people are worried about. But anytime you're taking away all of the easy money, of course, the market is going to have a reaction, particularly since we've been slightly overvalued in many of the sectors. So here's what I like to do. I like to follow 4 different bonds. That really tells me what the market is thinking through the bond market. Often is very smart. One is the junk bonds. So that is companies that have a high debt and pay a high yield. It has fallen down a bit, but still in a long-term uptrend unless it breaks down under 108. 2, I like to look at the TLTs, or the 20-plus year Treasury bonds. Yields are very low. That's somewhat of a flight to safety, but certainly still a lot of cheap money to borrow. Number 3 is I like to look at the 10 years, and they're still holding up firm. And finally, this is also an interesting place for the Fed folly, is the high corporate bonds, the bonds that have a high-grade corporate rating. That's also through LQD going up. So you put that all together, the Fed is still very much there to support this market as it goes through this period of uncertainty now.
You know, but I still wonder, and it's interesting how you lay that out so nicely there with those 4 that you're looking at. I often think that once they pull the trigger, and it might not be a tough pull of the trigger, it might be just a minor adjustment, that once we get confirmation of that, and I don't know how they announce that, even if they do, but you'll know, smart people like you who follow the markets will know. What will the market reaction be? Because then it's no longer a feared event. It's an event. It's happening.
Right. Well, if you remember in 2018, when it was more definitive at the end of the year that they were going to possibly taper or raise rates, the market collapsed about 20, 25%. But then immediately, the Fed stepped back and said, no, don't worry about it. And of course, the market then continued to rally. And so we're so far out of the woods in terms of a real economic recovery, other than the get back to normal, which of course is skittish now with the variant, so we could see another spurt. But overall, we still have to wonder, where is the real gross domestic product going to come from in terms of a real growth beyond that, which is why I don't think that I don't see any major sea change at this point. Of course, anything can happen. But again, right now, all you're seeing is a correction into support in a lot of the areas, and particularly in the indices.
Interesting. Michelle, thank you very, very much. Let's go to my buddy Charlie Gasparino on this. You know, I guess they